Hello, I'm Sabrina Pan, CPA. I advocate less taxes and more profits. Today, I'd like to talk about make the most of your charitable donation. As part of your holiday season of giving, consider giving to your favorite charity. It can also serve as part of your year-end tax planning. Additionally, we all want our money to go further, and charitable donations are no exception. Here are some tips to ensure that your donation makes the biggest and most positive impact. The first thing to do is proactively research charities. Identify the causes that are most important to you and your family. Do some research on those organizations that match up with your values. Then make sure the charity you donate to is a good steward of your resources. Websites like Charity Navigator and Charity Watch tracks the financial health and effectiveness of charities. Effective charities spend 75% or more of their resources on their services and 25% or less on fundraising and administrative costs. Second thing to do is to focus your support. Once you find a charity that meets your requirement, donate to it over time and let it know you are doing so. Repeat donation from a reliable donor save your chosen charity money because it doesn't have to keep sending solicitation to you every year. The third thing to do is that do not give over the phone or via email. It's often best to avoid donating over the phone or via email solicitations. These are two common ways thieves target their victims. In addition, charitable telemarketing campaigns generally use for-profit fundraiser will take a percentage of your gifts. This means the charity often receives substantially less of your donation if you give over the phone. Instead of reacting to a phone call or email, plan what charity you wish to give money to and contact the organization directly to make your donation. Fourth, ensure your donation is deductible. If you plan on itemizing your deductions on your tax return, determine if the organization you are donating to is designated by the IRS as a 501c3 organization in good standing. Many smaller organizations will represent themselves as a qualified charitable organization, but have not kept their nonprofit status up to date. You can check the IRS tax-exempt organization search page for a full list of qualified organizations. Reminder, cash donation of $250 or more require a written acknowledgement from a qualified organization in addition to your canceled check or bank receipt. It should indicate the cash amount or description of any property you contribute. Fifth things to do to make the biggest positive impact is to share your intentions. Whether your donation is a one-time gift or of a long-term commitment, check to see if there is an opportunity to match your donation. Oftentimes, employers will match your donation or others will promote a matching program. Also tell friends of your charity's efforts. Every little bit helps. The sixth thing to do is to consider qualified direct contribution from retirement accounts. If you are 70 and a half or older, you can contribute up to $100,000 directly from your IRA. This can be a great way to meet your minimum required distribution, and you will avoid some ordinary income taxes. 7 things to do is to consider donating stocks to yield bigger tax saving. Regardless how you make your payments, credit card, debit card, electronic fund transfer, or mailing a physical check, your donation is considered a cash contribution. Instead of making a cash contribution to a charity, you could instead make a stock contribution and see a potentially larger tax deduction. I'll be doing a case study. To illustrate, assume you purchased stock in 2015 for $10,000 and donated the stock in 2020 when the fair market value for the stock was $15,000. Below are 3 different scenarios and the tax implication, assuming your marginal income tax rate is at 37% and your long-term capital gain rate is 20%. The first scenario is donate cash instead of selling stock. Donating $15,000 of straight-up cash to charity decrease your taxes by $5,550 if you itemize deduction. You get a charitable contribution tax deduction equal to the fair market value of the stock when it's donated, which is, in this example, is $15,000 cash. Your income tax saving is 37% of that $15,000 or $5,550. The second scenario is to sell the stock and donate the proceeds. Selling the stock and then donating the cash proceeds reduce your tax liability by $4,550. Here's the calculation. Your income tax saving equal to $5,550, which is 37% of $15,000, and your capital gain tax pay equal to $1,000. Selling the stock first means that you have to pay taxes on the gain. Your tax liability is 20% of the $5,000 appreciation. The third scenario is donate the stock directly to the charity. Donating your stock directly to charity cuts your tax bill by $6,550. Here's how it works. Your income tax saving is still $5,550, which is still the 37% of the $15,000. Your capital gain tax saving is the $1,000. By donating the stock, you do not owe a long-term capital tax gain. This saves you 20% of $5,000. In summary, if your situation is similar to this case study, directly donating stock to a charity can potentially save you $6,550 in tax compared to $5,550 if donating straight up cash and $4,550 in the cash proceeds. Donating stock directly to a charity is slightly more complicated than donating cash and requires you to do it correctly. If you're considering making a donation of stock to a charity, please check with your tax advisor. There are new tax breaks in 2020 to help your favorite charity and yourself. The CARES Act authorized several new tax breaks for charitable donation in 2020. There are 3 additional ways to help your favorite charity while receiving a tax break for yourself. The 8th point is donate up to $300. More taxpayers are claiming the standardized deduction instead of itemized deduction thanks to the 2017 tax reform, which means that charitable contributions aren't tax deductible for many Americans. The CARES Act, however, allows an above-the-line deduction of up to $300 for a donation to qualify charity other than donor-advised funds or private foundations. In other words, you get a deduction whether you itemize or not. Any disallowed contribution is carried forward for 5 years. The other 2020 special is donate up to 100% AGI. The CARES Act also creates a tax incentive to donate as much as your 2020 income as you feel like giving. The annual deduction for monetary donation is normally limited to 60% of the adjusted gross income, AGI, but the CARES Act increased this threshold to 100% AGI. You can therefore effectively donate as much as you earn. This provision also doesn't apply to either donor-advised fund or private foundation donation. Any disallowed contribution is carried forward for 5 years. And as a business, you can contribute more. Businesses can also increase their giving thanks to 2 different provisions in the CARES Act. First, it raised the usual limit for corporate donation from 10% of their taxable income to 25%. Second, it boosts the threshold for a special enhanced deduction for gifts of food from 15% of taxable income to 25%. Under both provisions, any disallowed contribution is carried forward for 5 years. If you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to basecpaplus.com to sign up for our email newsletter full of tips for less taxes and more profits. Until next time, God bless.